Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Chuck Fuller, portfolio manager at Nasdaq Dorsey, Wright, to discuss if this is the last bear market rally of a cycle that potentially turns into a new bull market. Chuck, it's great to see you as always. Welcome back to Trade Talks.
Yeah, good to see you too.
And really, that's what the question is. We've seen the market actually string together a number of green days. U.S. equities, however, are still ranked number 3 in your asset class rankings, despite the rally. Cash is number 1. What are your thoughts around this?
Yeah, it's, you hope to see those increase more, with the kind of rally we've had. We're up, about 10% over the last month. But yeah, really haven't seen that budge. Like you said, cash is now number 1, commodities at number 2. I think this raises, some risk of this being another bear market rally, like we've seen maybe 2 or 3 other times this year. With some of our short-term indicators, I feel like every other time we've spoken, those things have been, incredibly low, and meaning that we should see some moves up. Now it's kind of on the other side of things where they're starting to get a little extended to the upside. And we're kind of around an area where other bear market rallies have failed. So I feel like we're in at a point right now where it's kind of do or die for the market. Either continue to rally, and then maybe this becomes the last bear market rally of the cycle, and we start to get into a new bull market, or we're kind of back into where we've been the rest of the year, and things kind of fall apart. So
right. And when you take a look at sectors, right, how are they ranking there?
Yeah, so the last month has been kind of interesting. So a lot of the high relative strength sectors have done very well, which usually off of a bottom doesn't happen. Usually it's the stocks that got beat up the most in the last cycle that performed better. But over the last month, we've seen sectors like energy and materials and financials outperform things like technology and consumer discretionary. So I will say that these kind of laggards have done better since the CPI report came out. So maybe that could be the catalyst for the next big move up. But really, in terms of our rankings, they've been pretty stable. So we still have energy at number 1, financials at number 2, consumer staples at number 3. Probably the biggest mover to the upside was basic materials, which went from number 7 to number 4 in our rankings. I think they were up about 20% over the last month. And then utilities was the biggest mover to the downside, fell from number 4 to number 6.
And Chuck, let's switch gears and talk about fixed income for a moment, because in addition to the readings that we saw with inflation, I think part of the other story was the velocity at which rates have moved, right? But now you're seeing the 10 years neither overbought or oversold, at least in the short term.
Yeah, exactly right. So, rates obviously moved basically straight up here for a while. And we've seen our first kind of break of support on the chart really since July here recently. And, like you said, we're not overbought now. We're not oversold. It feels like we've been overbought forever. But from this point, at least over the short term, rates could go anywhere. The trend is still positive in rates. It's just that, now we're not overbought. So, yeah, we could go back up. The next support level on the chart, I would say, is 3.6%. And so we're kind of looking at that to see if we can get a break there. But yeah, it's still treacherous out there in terms of rates. In terms of, different segments of fixed income, though, high yield continues to show improvement. It's actually number 1 in our rankings. And I think that surprises a lot of investors because that's a riskier area of the market. But what I try to tell them is that, that risk is mostly credit risk and not interest rate risk, right? And that's where we've seen most of the pain this year. If you look at other, kind of fixed income sectors, things like short-term treasuries, inflation protected debt, those kind of are other areas that are doing well. And those all have low interest rate risk too. So it kind of makes sense with the high yield story.
And let's take a look at commodities for a moment here, because as we had mentioned at the top, cash is now the number 1 position. Commodities falling into number 2 in your asset class rankings. But if we dig under the surface there, energy still number 1. We saw a little bit of a movement lower for agricultural, considering what's happening in wheat and coffee. What are you seeing under the hood when it comes to the commodity space?
Yeah, it's a lot of it's the same, right? Energy is still number 1. I mean, energy's been, far and away the greatest story this year. If you look at just its sectors, I mean, energy's up like 70%. Yeah, I mean, it's unbelievable. And so, like you said, agriculture moved down to number 3, mostly due to big declines in wheat and coffee. I think coffee was down almost 20% this month. But we have seen precious metals move up to number 2, which we haven't seen in a while. Now, a lot of times that can be a defensive thing, right? You always hear about, buying gold and silver during bear markets, that could help you. And they have posted great returns over the last month, even with the equity rally. So that's kind of another thing that gives us some pause. But overall, commodities are still doing well, even though they've fallen to number 2.
Yeah. And let's wrap up here and talk about international equities. I think since you and I have been covering this content together in 2022, I haven't really heard you bring up this asset class much.
Yeah, so there really hadn't been much to talk about. You could talk about the Russia war, I guess, but in terms of finding things that are good performers, there just hasn't been much there. But we have seen some notable increases over the last month or so. The international moved from number 5 to number 4 in our rankings. And it's getting fairly close to U.S. equities for the first time in a long time. I went back and looked at the history, and we haven't been really this close since probably 2018, when the international equities rallied at that point. And if you go back further back than that, you got to go back to 2010 to see them this close. So it's something we're keeping an eye on. Doesn't mean that you should give it a significant allocation in the portfolio. But I think it's an interesting thing to point out that it could be ready to move up. It has been out of favor for a long time, and it would be good to see for it to come back. Europe was up over 20% over the last month, which is pretty huge move, and we've seen developed markets perform even better than emerging markets during this rally, which is something you don't usually see.
All right. Appreciate the insight as always, Chuck. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.